Immediately to my right here is Adam Sieminski, the administrator of the EIA. Most folks in this room, I'm sure, know who he is. Adam was nominated by the President and confirmed by the U.S. Senate in 2012 to head up the EIA, the statistical agency of the Department of Energy. Now, he joined the EIA in June 2012 after over a 40-year career as an energy analyst in the private sector. Sitting next to Adam is Charif Souki. Now, Charif is the chairman and CEO of Cheniere Energy, and Cheniere is constructing the first LNG export facility in the United States at its Sabine Pass terminal in southwestern Louisiana, and developing a second LNG export project in Corpus Christi. Now, the format for the next hour and 10 minutes or so will be, we will start with some discussion and some questions to get the conversation stimulated, and then we will take questions from the audience along the way, rather than waiting until the very end. So keep in mind that we think this panel is really geared for what you guys want to discuss. So feel free to please participate. I will start off the conversation and then we'll jump into audience questions. And I think these gentlemen are happy to take the conversation wherever is most beneficial for each of you guys. So first of all, I'll talk to Adam for a second. And I know you guys have this new drilling productivity report that just kind of came out. And I got back from the Middle East today, and I'll tell you that when I gave a presentation at the MENA Shell Conference in Abu Dhabi, the Middle East is under this impression that what's happening in the United States may not be sustainable, that what we've accomplished as far as our production, because of the decline of the wells, the cost of the wells, that at some point this rapid increase will either slow down or retreat and begin to decline. The productivity, if you will, is not sustainable. Talk a minute about some of the things you guys have observed. There might be some anomalies in the report that you didn't think were going to be there, and kind of discuss the theme of, look, is this sustainable long term, and are they accurate, or are they just under a misconception?
Well, let me start by giving just a little bit of background on why we wanted to publish our drilling productivity report. It's covering the 6 major shale formations in the U.S. that over the past 2 years have been responsible for something like 90% of the increases in oil and gas production in the U.S. So that's the Eagle Ford in Texas, the Permian Basin, which is mostly in Texas, the Haynesville natural gas field, which kind of goes across Texas and Louisiana, the Niobrara in Colorado, the Bakken field mostly in North Dakota, and the Marcellus, and particularly in Pennsylvania. Now, because a lot of the growth is coming from these formations, and because it is so rapid, it is imperative that EIA has this tool now available to inform our other products. The Secretary mentioned that the annual energy outlook is coming out this coming Monday. So when I got to EIA last year, the annual energy outlook for 2013 was published in December. That was the oil and gas projections in there that go out for 25 years were based on numbers that were coming from our surveys, not the drilling productivity report, but our traditional surveys, with a lot of lags in the data. Some of that, the basic data we were working with was 6 months to a year old to start our projections from. And in an area like the growth that's occurring in the shale formations, we were, in a sense, behind the curve before we even got started. Now, with the drilling productivity report, we have estimates of current and 1 month forward. So in the December drilling productivity report, we have estimates for January of 2014. That's a much better place to start the 2014 annual energy outlook. Okay, so let's come back to the question of what do we know about these fields and whether or not this phenomenon shale gas and shale oil or tight oil production is sustainable. One of the things that's very, very clear from the drilling productivity report is that the technology is still moving, that well efficiencies are changing and getting better, and drilling rig efficiencies are changing and getting better. So the whole idea that because they have steep decline curves, typically production from shale reservoirs, that this has to be a bubble is not really being borne out by the research that we're seeing in the drilling productivity report that says that continuing improvement in the efficiencies of both drilling and production can offset the decline curves. You also want to keep in mind that as more and more of these formations are producing, the tail ends of the curves are beginning to add up. Now let me just explain that and I'll stop. The decline curves, these very steep decline curves, production declines very rapidly in the first year or 2 years of output. Well, that's true, but there is a very long tail, a decade or 2 decades of production that comes from these wells. And if you have enough of these wells drilled, that long tail of production begins to add up. So I think that it's very possible that certainly for shale gas, EIA does not see any near-term peaking at all in U.S. shale gas production. On the oil side, I think that the numbers are still pointing towards a plateau and then a decline sometime in the period after 2020. But I think that we are still in early stages of understanding what's going on the oil side. So, Chris, I'd argue that in fact, the potential for shale in the U.S. is still very, very strong. Final 15-second comment. EIA published earlier this year a study of shale gas and shale oil resources globally, and there are many resource indications for shale outside of the United States, and many of them are being worked on. Now, there are some really good reasons why it's happening as quickly as it is in the United States, but I think it would be wrong to assume that we're not going to see shale in other countries.
Sure. So the Middle East should be scared, worried.
Well, you don't have to be scared or worried. I think that what you would really want to do from a business perspective is just simply look at it and try to figure out if this is the least expensive way to produce oil and gas, and if it is, get on board.
Charif, you look at worldwide, global energy now. The puzzle's kind of changing with LNG. I think you look at Australia, you look at other countries around the world, and they're kind of stopping to take note as to what really the United States is going to be able to do with LNG exports, and having the first lower 48 state export terminal. I think a lot of folks are looking at to see what Cheniere is going to be able to do. Ernst & Young had a report that talked about a bit of, Henry Hub plus some number to gasify, liquefy, and transport gas to Europe and Asia, and that if numbers began to rise on Henry Hub in the United States, it might be an uneconomical process to get gas to Europe, yet the first major contract you guys have signed is with Centrica or British Gas. So where do you see, the idea of LNG if Henry Hub continues to rise to a number, say, above $5? Is it going to be economical to go to Europe, or is it really the focus you think for America, not just Cheniere, but America, going to be maybe Asia?
Well, I was just listening to Adam. He said it's not going to happen, so I don't really have to worry about it so much. It's not our problem. I think you have an option, an opportunity to take advantage of a situation in the United States that is dramatically different. Sure. So if you're a global buyer, you need to have some exposure to in your portfolio to the opportunity to source hydrocarbons from the United States. At the end of the day, whether you turn out to be right or wrong, over a 20-year life, you're probably going to be wrong at some point. History has shown this. Every time you make a big investment based on what you think is going to happen, more than 5 years down the road, you turn out to be wrong.
Right.
And we're well paid to know this. We've done it.
Sure.
So I think to sort of confirm differently what Adam just said, for us, the world changed in 2006 when prices went up very high in the United States. And all of a sudden, all the metrics that we used to count on to build our models turned out to be not valid anymore. And so you couldn't model. And what you couldn't model is the fact that people were discovering what they could do. In fact, even the producers sometimes were working around in days going, not believing themselves how well they were doing. And the consequences of, if they were doing really that well, what else did they need to do? So some of them very quickly said, okay, no more gas, we need to go to liquids. Some of them were slow to do that. And it's very, very difficult to build a model based on this.
Things are moving very rapidly, very quickly is the point, right? 1-year-old data is almost like 10-year-old data, it seems like now.
Well, this is the funny thing about our business. We make 20 years investment, but everything changes every 5 years. So,
are there any questions from the audience yet? Anything would like to bring up or ask topic-wise, whether on the last two comments or anything you want to fire at Adam or Charif?
You know, one of the things, Charif, that when you don't know what the environment that you're in is going to be, most companies then say, well, then we have to manage what we can manage, and that generally tends to be costs. As you look at your cost structure and keep your cost structure as lean as possible, and that way it doesn't really matter what happens to oil and gas prices. We know that that demand for oil and gas is going to be around for a long time.
Sure.
And maintaining a good cost structure is how a company survives.
Question here?
No mic yet.
It's not on.
Lou.
You know, one of the things on these big LNG projects is the buyers and sellers have to make some kind of long-term commitment. And I'm wondering, it looks like the oil index with various is under some kind of revision or attack, but what might it be replaced with? Could it be replaced with a number of different ways? And how do buyers and sellers come together in a long-term deal when they have to look for a different way to sort of each share the risks? Have you begun to see something that suggests we're moving to a different kinds of index?
I have no doubt in my mind, but of course, not everybody agrees. For me, the sense of pegging the cost of one commodity to another makes no sense whatsoever. Price is a signal that the user sends to the seller, please make more or please stop. And if you peg to a different price, there is no signal. So you end up building capacity that is not needed or not building capacity that would be needed. I've made this argument 5 or 6 years ago, and for the European market first, and slowly we're seeing now that the market in Europe is going on gas-to-gas competition. Whether it's a TTF index or the NBP or whatever it is in Europe, it doesn't really matter. They're going to have gas markets in Europe, and they're going to do all their trading based on those markets, and it makes a lot of sense. And they will be eventually, I mean, they're very well correlated in Europe, and eventually there's no reason why they shouldn't be correlated with Henry Hub as well. And we have a number of markets in the United States where they're correlated to some extent, and sometimes you see a break in the correlation, and it's for very regional reasons, and that really is what makes a market. Asia will follow. It's just a matter of time.
So Lou, let me just provide just a bit of historical perspective. Why do we end up with oil-indexed natural gas contracts? The first LNG projects were really gas being produced in Southeast Asia and being, Indonesia, Malaysia, Australia, and going up to places like Korea and Taiwan, Japan. Those countries were producing electric power from oil. And the idea of indexing natural gas to oil when the fuel that was being replaced was oil, I think made some sense to the buyers, and certainly made sense to the sellers who said, well, you're either going to have to pay an oil price or pay me, an oil index price. I think that what Charif has said is that in a world where the competition is no longer with oil, but it might be with coal or it might be with some other fuel, the opportunities for that indexation to change are very high. One of the interesting things that you get when you have this big discrepancy, and the ratio between natural gas prices and oil prices, $100 oil is about $20 a million BTU, and gas is selling for $4 or $5 a million BTU, so you've got a 4 or 5 to 1 ratio. You're creating a tremendous incentive for somebody to figure out how to use natural gas in something else that's using oil, and if it's not a plant making electricity, maybe it's going to be in a diesel-fired truck or a train running on diesel fuel or something else like that, where natural gas can compete very, very effectively against oil.
So I think that's what's really interesting. If you look at the co-gas deal, clearly the Koreans appear to be willing to accept the price risk at Henry Hub. Sure. But they took a piece of it. They said, well, let's cover the liquefaction cost. Let's put the person that produces the LNG and the buyer, we'll take a take or pay on the process, but we'll take the price risk. But that's got to be revolutionary to the market long term. It's got to eventually, you can see the Asian buyers are looking at this very carefully. They want to know how they can get to this.
See, Lou, I don't agree with you. It's basically people react to what they know today. If you go back not so far ago, 2009, at the beginning of the year, you had $40 oil prices and $6 or $7 gas prices in the US. It didn't work. So nobody was trying to do it. By the end of the year, and this is how fast things go in our business, oil prices were 70, 80, on their way to 100, and gas prices in the US had come down to under 4. And then all of a sudden it worked. And it took us, 18 months to convince people that this is real and it's going to stay, and therefore you really should look at it. It didn't take very long. Once they see it in front of them, the buyers will say, okay, I got to do this. And once one does, then the second guy has to follow. He has no choice.
Not wanting to pick on you, so I have a question that I think a lot of folks are asking now. In the
It's
media,
perfectly fine with me if you pick on Charif.
in the last 6 months, there's been a lot of media coverage, I think, of this idea. And a lot of folks still, I don't know, are convinced there's this undertone of a manufacturing renaissance. We heard from the secretary that there's a lot of industry, moving to the United States or new plants being built. They want to take advantage of natural gas as a feedstock. It's abundant, it's cheap, quote unquote. I know that other parts of the world are looking at America now being more competitive globally because of our attraction now to industry because of our natural gas supply. Is there anything in your mind that says, will the president, will our administration, our government allow us to ship out any quantity of gas at any price? But if gas begins to rise, will there be a cap or a tax or anything that would put some sort of negativity around that? And then the second question is gas exportable at any price? Is there a buyer somewhere in the world for gas at $8, $10 Henry Hub?
Sometimes. Just a matter of finding the person who absolutely needs it at that particular time.
Okay.
There's also somebody who's going to sell you the gas at 50 cents because his facility is overloaded and his storage completely full, and he can't continue to produce it unless he sells it. So you're going to find everything.
Okay.
And if you try to build a model that says, I'm going to engineer everything,
Doesn't work.
you're going to be wrong. But I'm willing to concede that I will listen to the person who was right 5 years ago when they predicted what was going to happen this year.
Right.
So show me a model from 5 years ago that
rearview
shows
mirror,
where we are today. I listen to that person who can produce that model.
Okay. Other questions from the audience? Oh, microphone here. Would you introduce yourself and then before you ask your questions, name and who you represent?
Sure, I'm Gregory Morris with Hart Energy. Question for both gentlemen from your respective perspectives, and that is, there has also been a lot of debate in the United States vis-a-vis this manufacturing renaissance of how much of that patrimony do we want to give away. I mean, we've seen quite publicly Dow Chemical stomp away from some trade associations because they wouldn't condemn LNG exports. And yet there are industry people who say, or industry gas producers who say, you know, if we really export, if all of the export terminals are built and demand really goes through the roof, then, you know, we get to $7 and even the dry gas in the Haynesville is producible and then price comes back down. So I'd like to hear from both of you, one an actual exporter and one on the numbers side, where you think that balance is. Should we, not, as a matter of policy, not export too much or let the market decide?
Well, I would say that on my previous premise, Dow Chemical is disqualified. What they thought the world was going to look like 5 years ago is not at all what it turned out to be. So since they're an investor in Freeport, they thought they were going to import natural gas, and they were in favor of free trade back then. Since they now benefit from very cheap ethane that basically bailed them out of bankruptcy, and there's no fault of being almost bankrupt because I've been there. but you still have to deal with it. So what we have learned is that we're not going to try to second guess the market. The market will tell us where we need to go and what we need to do, and we're going to try to interpret the things that we see today. But we don't have an opinion that we can plan 5 years ahead of time. The manufacturing renaissance, it is happening to some extent. I think instead of looking at what people are talking about, they will build maybe one day, look at what has started. It's not that much. And when they start actually putting roots in the ground and they start digging holes and building things, okay, then we really will know how much it is. Clearly, you're going to have a manufacturing impact. You're going to have factories that are relying on very cheap hydrocarbons in the United States compared to the rest of the world, and going to take advantage of this in the United States. But when you look at the number of all the manufacturers in the United States and what percentage is actually energy sensitive, it's not that big a number. It's somewhere between 2 and 10%. So it is not a driver for most of the manufacturers in this country, which is why you see the National Association of Manufacturers continuing to say we're in favor of free trade, let the market decide. It is only the very limited chemical producers that may have an advantage. And since they're getting their ethane so cheaply and the rest of their products so cheaply, and methane comes as a byproduct, I'm not quite sure I understand the logic of saying we want to restrict one without the other. You restrict methane production, you're going to restrict ethane production as well. So I don't understand the logic. But at heart, I'm a free trader. And I'm a free market. I heard the secretary earlier. I'm delighted he's doing all the things he's doing in terms of encouraging people, but please not us. I don't want any favors from anybody. I don't want any subsidies from anybody. I don't want any guaranteed loans from anybody. I want to stand on my own 2 feet. If I can make it, I will make it. If I can't make it, I shouldn't be in that business.
So you're looking at me now.
Yes, what do you have to
I'm
say?
kind of in a tough spot here because Charif has already said that forecasts, out, to 5 years or maybe even shorter than that are probably not worth a whole lot. And you want me to comment on policy issues, and by law, I have to make long-term forecasts, and I'm not allowed to talk about policy issues. So EIA is not a policy organization, right? We're sort of like Joe Friday and Dragnet, just the facts, just the facts. So let me give you a few facts. In our annual energy outlook for 2014, the reference case, which is going to be published on Monday, we are identifying, let's say out to 2025, that there's probably going to be a pretty decent pickup in natural gas consumption by electric utilities, a good increase in natural gas consumption by the refining industry. This is actually helping with the costs in refining. The bulk chemicals industry, which Charif just spoke to, even food, iron, and steel. Now, even with increases in all of these manufacturing activities, which you heard the Secretary say is good for the economy, good for national security, and is compatible with the environmental goals, certainly in the near term. EIA believes that there will be sufficient supply to allow for an increase in LNG exports. So, whether there should be limits of some type or another, that is a policy question that the Congress and the executive branch will figure out. Charif has given you his view on letting the markets sort that out. What I'll try to do is just to provide as good of information as possible to policymakers to let them come to their own conclusions.
Adam, one thing you want to go ahead, Charif?
That is
Sure.
incredibly important. That makes the difference between this country and the rest of the world. We have the benefit under Adam and his predecessors, Richard Newell and Guy Caruso, of really unbiased data that allows people like me to make decisions.
Good point.
I don't want to say intelligently, but at least based on, intelligent information. And this is so important and makes such a big difference compared to trying to make investments outside of the United States.
One thing you didn't mention, and I don't know if you left off intentionally or not, is natural gas in wide adoption for transportation. Where do you guys see, and what would it take, and what's been the hindrance of us accepting, natural gas as a transportation fuel when other countries like China are using it in wide-scale adoption? We seem to be very slow to the game, even though we as a country have 100 years plus worth of supply and cheap natural gas. It would seem like it would be a perfect marriage. Why have we not, as a country, ran to it?
I think Charif has already answered that question. 5 years ago, we didn't think we had 100 years supply, and we had natural gas prices that were in double digits.
Sure.
And gasoline and diesel fuel and electricity, electric vehicles, hybrids especially, looked like a pretty good
But
way
China
to go.
has gas
Right.
today at double digits, and they're adopting it for transportation.
Well, China is now the world's largest oil importer.
Right.
And they have perhaps a policy incentive to try to do something like that. I think that the U.S. has indeed had a tendency to try to let the markets sort these things out. And there are shortcomings in lots of different fuels. I mean, a shortcoming in compressed natural gas vehicles is they don't have much range, and they reduce the trunk space, for example, in your car. So compressed gas works pretty good for buses and things like UPS or FedEx delivery trucks or post office trucks where there's central refueling and that kind of thing. And we're doing a lot of that. LNG in transportation is certainly beginning to look much more attractive. If the oil to gas ratio stays somewhere between 3 and 4, and in EIA's long-term forecast, that's where we think it will be. That's going to provide an incentive for long-distance trucking firms to look at LNG as an option, and the same thing in the railroad industry. There's already people in the coastwise maritime trade that are investigating whether LNG could be used in some of the tankers that move oil products around. Speaking of oil products, I wanted to mention that the question that came up during the Secretary's talk about LNG exports and oil exports. I think the comment, it sounded to me that the questioner was saying we're not exporting oil, and in fact that's wrong. The United States is exporting 3 million barrels a day of oil products. Now we're also importing a little bit less than 3, so we're actually a net exporter of oil products, but we do export lots of gasoline, diesel fuel, and other products. The United States exports about 200,000 barrels a day or so. It goes up and down of oil to Canada. It's much harder to, all of the, as the Secretary exactly and correctly indicated, the export permits for products and crude oil are handled by the Commerce Department. You know, there's, and the U.S. is still importing, you know, 7 million barrels a day of crude oil, and as a consequence, you know, we really aren't quite there yet on the idea of net exports of all oil. But in EIA's longer term projections, if you have a high resource case for oil shale production and you have a low demand case with some of these things like the Secretary indicated, substitution of fuels, better technology, improvements in fuel efficiency standards, demand for liquid fuels is going to decrease, and the possibility that the U.S. could be a net exporter of liquid fuels is not out of the question.
Other questions? Questions from the audience? Oh, in the back here. Phone. Wait for what microphone real quick so we can hear. Sorry. There we go.
Hi, I'm Jessica Resnick with Bloomberg's Oil Buyer's Guide, and I'm curious, Adam, you had said that the U.S. is obviously in a place where it could eventually possibly be a net exporter. My assumption is that that would only be of light grades of crude. Does the EIA at this point break it down and look at what we could be putting out or what we could be exporting, what types of crude we would see exporting? And if so, how soon do you see us exporting sort of what types of crude, I guess, is the question. Sorry.
Well, in terms of how much oil the U.S. would export, again, it's a policy issue. You'd have to have a permit from the Commerce Department. I'm not going to speak for the Commerce Department. I have said since becoming EIA administrator that there is an increasing production of light sweet crudes going on in the U.S. Shale oil, by its nature, tends to be light and sweet. And so that's what we're getting from the Bakken. The Bakken is up to 1 million barrels a day. That's what we're getting from the Eagle Ford. That's at 1.3 or 1.4 million barrels a day. We're getting more light sweet crudes from the Permian Basin. And so at some point, we're going to have a lot of light sweet crude oil. You know, I'm thinking that I'm really enjoying being up here with Charif because he's exactly right. I mean, 5 years ago, 10 years ago, the industry was making huge investments in the ability to process high sulfur, sour, you know, heavy sour crudes down in the Gulf of Mexico, and now they're faced with increasing domestic production of light sweet crudes. So what do? And there's all kinds of things that can happen. I mean, infrastructure can change. We're moving light sweet crudes to the east and west coasts where it can be used in those refineries, where some of that crude is actually going to Canada. And it, as I said, you know, getting a permit to send crude oil to Canada is pretty easy. And there can be changes in refinery configuration in the Texas Gulf Coast area that would allow them to process more light sweet crudes. And so you know, there's a whole range of options. I think that the markets will come up with, and in fact is already doing. I mean, there are companies that are building refining facilities that can use light sweet crude in some way, then allowing them to have more products that they can export. So, I suspect that obviously these questions aren't going to go away as long as our production keeps climbing and our demand keeps falling. But I think that there's plenty of time for policymakers to figure out what they want to do.
You want to go at Charif?
Yeah, I'd add
Sure.
one thing, which may be surprising, but I really do believe it. I have enormous faith in the ability of the regulatory systems and the political systems in the United States to do the right thing for the most people. So you may not always be in that category, and therefore you don't like the results. And sometimes it takes longer than you would like to, so it hurts in the meantime, but eventually you get there. So there's a couple of things that have happened in the last 6 months which really makes Adam's life a lot more difficult. EOG announced that the result of a well test in the Eagle Ford that produced 5,000 barrels a day. That's just insane. Okay, that means you get your money back in 30 days. Now, EOG was playing their cards very close to the vest and was not telling people why they did this. And clearly, they don't want their competitors to do the same thing they've done. They broke some kind of code. And the question is, are you hurting the future profitability of the well and the future productivity of the well? Or have you really figured out a way to produce 5,000 barrels a day in the beginning and then still maintain the life of your well on a long-term basis? That changing things dramatically. Recently, with no announcement, I found out that some people in the Permian Basin were now able to produce 800 barrels a day, which means you get your money back in 6 to 8 months. Now, the Permian Basin is enormous. If you can apply that kind of economics to a very significant part of the Permian Basin, we're going to have another surprise like the Bakken and the Eagle Ford that end up producing a lot more than we ever expected 5 years ago. So when you try to model all this and put it together and say this is what's going to happen, it's impossible. But at the same time, when it becomes accepted that this is really happening and the trend is continuing, and what Adam said earlier about we're really early in the oil game, we now know the gas game better, but the oil game is still early. But if in a year or two the oil game looks like it is going to follow suit and it's going to be the same kind of dynamics, I guarantee you the rules will change and we'll make the decisions that we need to make. And frankly, in the first instance, we're either going to agree to export or we're going to review the way that we refine, because all the people who built very expensive hydrocrackers will come back and say, I need a new permit now to go back and process lighter crudes and condensates. But some policy decisions will need to come, and I'm absolutely convinced that they will, as soon as we feel that all these numbers are real and the production trends are continuing.
Since this is themed sort of midstream, I guess we feel compelled to at least have a comment about the midstream business. Earlier this year, the WTI Brent spread, reversed for the first time since October 2010, I think. A lot of conversation was about because of crude by rail, moving oil around in the pad areas where it needs to go because of lack of infrastructure, piped infrastructure. The Keystone XL pipeline, the most talked about pipeline that's never existed and still not approved. If the Keystone, or when the Keystone XL is approved, will crude by rail still grow at the rate it's growing? Do we need all of these infrastructure pieces to move oil? If so, are we there yet? Is there still massive investment needed? If so, in what areas?
You want to go first?
Let's just stare at Charif until he answers.
I'll try it. Let me. Amid the whole infrastructure thing, one of the other things, again, the Secretary mentioned this thing called the QER, that stands for Quadrennial Energy Review, that the Energy Department will be coordinating with Melanie Kenderdine, trying to look very carefully at these infrastructure issues across all energy. I think, when you say midstream, you're really talking here about oil and gas, kind of the area, what happens between the wellhead and where refineries are.
A lot.
Right. So there's a lot in there. There's pipelines, there's barges, there's trucking. There is now railroading. I mean, there's more than 1 million barrels a day of oil being moved by rail now in the U.S. Interestingly, this is another, this is one of those flaws. EIA is not collected very timely. We have some data monthly and annual on rail movements, but it's not very detailed, and it's not done on a weekly basis in the same way that some of our other statistics are. And the reason for that is that if you go back a few years, we never envisaged the need to collect data on rail movements. One of the things that I'm pretty sure about is that oil is going to move in some way. I mean, if the oil is being produced, I suspect that that oil is going to get to a market in some way or another, and that's what we discovered with the Bakken. They didn't have a lot of pipeline infrastructure in North Dakota, but rail infrastructure could be built pretty quickly and hook up with rails who were eager for the business because their coal hauling revenue was falling, and so we're finding that that's a way of getting the business done. On Keystone, keep in mind that the lower half of Keystone, from Cushing down to Houston, is going to be in service probably in the next, I don't know, somebody is going to know this here in the next month or so. And you mentioned differentials. Everybody's been familiar with the pretty wide gap that opened up, then closed, and now is opened up again between Brent crude and West Texas Intermediate, or WTI. But we've now had a pretty big gap open up with the Gulf Coast crude. So Louisiana, I just figured out, by the way, that it's light Louisiana sweet. I've been saying it wrong my entire life. Light Louisiana sweet crude is selling at a discount to Brent. The crude from Eagle Ford, a lot of which is being termed light Houston sweet, is also selling at a discount. And so we're getting to the point where there's going to be a lot of oil in the United States. It's going to be selling at below what would typically be thought of as world oil prices.
You want to add anything, Charif, or no one's going to put you on the spot? But
we have about 1,700, 1,800 rigs that are working. They're getting more productive every year. We're drilling somewhere between 40 and 45,000 wells per year at a cost of between 150 and 200 billion dollars.
Right.
And yet we're only investing 15 to 20 billion dollars a year in midstream infrastructure.
right.
The industry likes to say that there's a 3-to-1 ratio. I'm not quite sure how they came up with this. This was an environment where everything was kind of rigid and fixed, and we knew where we were going to produce it, where we were going to sell it, and the infrastructure had already been built. So I'm not sure these ratios survive and are valid, but I think there's a serious dislocation here between how fast we're drilling upstream and how slowly we're building the infrastructure.
That's a great point.
Regulatory problem may be part of it, but also financing problem, because not everybody is lucky to be able to sell 20-year contracts to investment-grade counterparties. So if you're starting to take a risk on basis between the Rockies and the Northeast, for instance, not pointing fingers at anybody, but 5 years later, you can have a pipeline that costs you billions of dollars that is no longer relevant. Or if you build a regas facility for a couple of $1 billion, you can point the finger right there because I know who did it. That may not be relevant, but you had a 20-year contract supporting this.
Right.
If we didn't have 20-year contracts to support this, can we do the same thing in ethane? Well, ethane, if you're going to build a cracker for ethane, you're counting on the differential between ethane and naphtha.
Right.
Can you say with certainty that for 20 years that differential is going to be there? And if you don't, Do you have the courage to make an investment based on a
out on
temporary
a limb,
difference in prices? So there's a tremendous amount of questions that not simply the policymakers have to think about, but the strategists within the companies and, and the investors need to make in terms of what kind of risk profile are they comfortable with and what kind of risk are they willing to underwrite.
Sure. Any other questions in the audience? Right here and a couple over here.
Sorry, it's Carrick Morris. I'm Oliver Wyman. Very quick question just around sort of the rail infrastructure piece. Obviously, sort of with some of the issues that we've been having with the rail infrastructure, there are constraints and regulatory components which have been built in. Do you see that slowing down some of the crude by rail type processes and bringing some of the pipeline elements back into play?
Well, it certainly could. That's going to be up again to regulators and policymakers how they're going to do that. And it's not just in the United States. I mean, Canada's had a worse experience than we've had in the U.S. in that regard. And so what the Canadian regulators are going to do is going to be just as important, I think, as what's happening in the U.S. I do know that some time ago, the Environmental Protection Agency had a study prepared that tried to look at what the safety statistics were on moving oil by pipeline, rail, barge, and truck. And the conclusion of the EPA at the time was that the safest mode of transportation is pipelines.
Sure, sure.
It's the first time that Rich can do like the EPA.
Was there a question right behind here, sir?
Thank you. Yes, Jay Doherty with Mercer. We've heard a lot today over the technology and productivity efficiency improvements. Question is, really, we've seen a few large capital projects, emphasis on few, put on hold because of workforce constraints, either from the build or operate. Do your models, Adam, and your decisions, Charif, have any concern about fueling this energy powerhouse in the future in terms of talent, particularly in unconventional and LNG, where other countries are starting to look at expanding in that area and don't have a talent base, so they look to the U.S.?
Well, let me try a quick answer to that. I mean, we do know that we've experienced labor shortages. The two that I can think of immediately are big problems in the Western Canadian Sedimentary Basin when activity was really heating up back there in 2005 and 6 and 7, and then Australia when a number of LNG projects were all under construction at the same time. In EIA's models, we do try to take that into account, usually by just putting in some kind of a factor to try to slow things down a little bit. It's hard to actually model that in a really sophisticated way because we just don't have the kind of tools, and what's already a black box model would get even harder to understand. So what we tried to do on LNG was to say, let's just assume that only so many LNG facilities can be built in a year without creating a problem like that, and that's how we tried to address that as far as LNG is in the U.S. Charif, I think probably could comment on this. I'm sure there is a relatively limited ability of the industry to do too many LNG manufacturing facilities all at once, and in fact, that might be one of the answers to people who are concerned that we'll be exporting too much LNG, that the market itself will put some brakes on that activity.
Yeah, I think people forget that it takes 3 years to plan a major project, and it takes 4 to 5 years to build it. And not simply in the LNG space, but also in the manufacturing space.
Refineries.
Petrochemical. about 3 years to plan it and permit it, and about 4 to 5 years to build it. So if you start talking about something today, in all likelihood, your problem is going to start materializing 3 or 4 years down the road. And you're going to peak 6 or 7 years down the road, and you're going to be finished by 8 or 9 years down the road. Because also all those large projects don't come on stream all at once. They come on stream over a period of time. There's a ramp-up period. So last year we spent $5 billion. We hired 2,000 people. In 2014, we will get to about 4,000 people. And at the anecdotal level, we're starting to reach limits in terms of competence of trades, competence of professional people. We're short of engineers. We have not trained engineers in this country in a long time, so most of our engineers are now in their late 50s, which I think is young, but I'm unique in my company in that sense. And we need different trades like welders and technical people with good, solid education, and they're getting harder and harder to find. So yes, we are going to have some constraints. And yes, as we plan projects, we need to be deliberate about it. And you know, given how fast we did Sabine Pass, people have been asking us, why aren't you doing Corpus Christi as fast? Well, it just takes time. It doesn't happen overnight.
So I do know, Charif, and I'm sure you've probably hired some of these people, that a lot of the states that have activity occurring, Texas, Pennsylvania, Ohio, and others, the university systems in those states have stepped up and are actually trying to lift their game in technical education.
And you have to do that. You have to work with the state universities. You have to work with the technical colleges. You have to put employment fairs. You have to train people. And it has to be part of your planning. If not, you're going to have a real major surprise when you start recruiting people to build your facilities. So we have outreach programs. We try to hire veterans. We run the gamut. And this is very, very much part of what you need to do if you really want to build a facility of this size. The good news in the US is it's there. You can find the people and you can train them, but you have to plan it.
One question here, and then we'll have one last question, and we'll have to wrap it up. Sir, go ahead.
My name's Ed File. This is a curiosity question because I don't really understand it. I know when we import crude oil, we then process it and export higher value diesel fuel, gasoline, and stuff like that. So I understand that model. But from an energy security perspective, on the natural gas front, if we export all the natural gas to other countries rather than have it here, then in future years, we end up without natural gas supply. So I was wondering if somebody would help me understand that, because I wasn't following it because we were not doing anything in the value-added category for natural gas.
Well, I'm going to help Charif out here just a second. I think it would be really wrong to assume that building a huge LNG facility, which is like a refinery, which is a manufacturing facility, is not adding value. So that's certainly one part of the equation. On the issue of, is it better to keep it in the ground than to sell it? I think that would you'd have to think about that in the context of everything that you've heard up here already on how quickly the forecasts change and how the technology has changed. There are economists that have tried to run calculations like that, and most often what they show is that for any discount rate, higher than zero, keeping a resource in the ground in order to save it for the future just doesn't make any economic sense.
Charif, you want to comment? Or?
Yeah, I will add that the notion of no added value would come as a big surprise to the 2,000 people working at the plant. They wouldn't view it very positively if you fired them tomorrow. And the biggest surprise to the people who count on us to start production in 2015 so that they can have 30,000 jobs drilling the wells that are necessary to deliver the gas to the plant. So my humble opinion, that does represent value.
So if you thought about this from a national security perspective, I mean, one of the things that I would say is that having, there's stock and there's flow in economic decisions. And having flow is a very valuable thing. If there's a crisis somewhere, having the ability to redirect flow becomes an extremely valuable policy tool. And I think that's why the country literally is struggling so much with this. I mean, I think that questions like yours are good because it gives everybody an opportunity to think about what the costs and benefits or the pluses and minuses are, and to try to balance off those things. I'm going to refer back to the Secretary again. What he said was that if you're thinking about energy policy choices, you have to think about at least three things. You've got to think about what it means for the economy, what it means for national security, and what it means for the environment. And it's a balancing act because you very seldom find things in the real world where everything is contributing perfectly on all three of those fronts. And that's why we have a democratic process to try to sort out how we're going to put the weights on those things to try to arrive at a decision. And it's not easy. And I'll come back to, it's like, and again, if you say, well, what's EIA's role in all this, is to try to provide enough factual evidence that the thinking about these things by policymakers and the public is informed.
Well, that concludes our session. I think some of the themes we've heard today really make you think that the world is now looking at the United States in a much different manner now that they've seen this revolution begin to actually take a foothold, and I think the world is watching to see just how far we can take it. So I wanted to say thank you to both Adam and Charif for spending an hour with us here on the stage. I know that guys of your caliber try to talk for days up here about this, but folks have other things to do.